Real estate can be a smart investment choice for many reasons, but one of its most attractive features is the array of tax write-offs it offers. But what are tax write-offs in the first place? Well, tax write-offs are like special discounts that the government gives you to help you save money on taxes. And when it comes to real estate investing, you can use many tax write-offs to save money. Hey, what's going on? Welcome back to Tax Premier. I'm your host, Johnathan Wood, where we dive into everything finance and help you pay the least amount of taxes possible. In this video, you'll learn about 9 tax write-offs so you can keep more money in your pocket from earning from your rental properties. So like, subscribe if you haven't already, and let's get started. So what tax write-offs can you enjoy as a real estate owner? Well, let's start with mortgage interest deduction. One of the key tax advantages of owning real estate is the mortgage interest deduction. This deduction allows you to reduce your taxable income by deducting the interest you pay on your mortgage loan. Now, here's how it works. So let's just say you have a mortgage on your property and you pay $20,000 in interest each year. With the mortgage interest deduction, you can subtract this $20,000 from your taxable income, potentially saving you thousands of dollars in taxes. For example, if you're in the 25% tax bracket, deducting the $20,000 in mortgage interest could save you $5,000 in taxes. This means that effectively you're paying a lower interest rate on your mortgage because a portion of it is tax deductible. Now, the beauty of the mortgage interest deduction is that it allows you to leverage your real estate investments effectively. Even though you may have to pay interest on your mortgage, the tax savings can offset this cost and increase your overall returns. The next write-off we have is capital gains exemption on primary residence. Now, when you sell your primary residence, you might not have to pay taxes on the profit you make. This special tax rule is called the capital gains exemption, and here's how it works. So the capital gains exemption allows homeowners to exclude a portion of their profit from selling their primary residence from their taxable income. So you could be eligible for this exemption if you lived in your home for at least 2 of the last 5 years before selling it. Now, to qualify for the capital gains exemption, you need to meet certain eligibility criteria, such as using the property as your main home and meeting the ownership and residency requirements. This exemption can lead to significant tax savings for homeowners, especially if the value of the home has increased since you bought it. Now, imagine if you bought your home for, let's say, $300,000, and after living in it for a few years, you sell it for $500,000. Normally, you would have to pay taxes on the $200,000 profit you made. However, with capital gains exemption, if you meet the eligibility criteria, you can exclude up to $250,000 or $500,000 married filing jointly of that profit from your taxable income. So basically, this means you could potentially walk away from the sale without owing any taxes on that gain. Moving on to our third write-off, we have depreciation. Now, depreciation is another valuable tax benefit for real estate investors that allows you to deduct the gradual loss of value of your property over time, lowering your taxable income and potentially reducing your taxable income. Now, typically, you can depreciate the structure of a property over 27 and a half years, but certain components like a new kitchen or hardware floors may be eligible for accelerated depreciation. This means you can deduct a portion of these costs each year, further lowering your taxable burden. But however, depreciation can be complex, and it's essential to understand the rules and regulations surrounding it. So, moreover, strategies like cost segregation analysis can help optimize your depreciation deductions, but it's crucial to conduct thorough research or consult a tax professional to ensure that you are in compliance. Let's now draw our attention to the next write-off, wages for employees and independent contractors. Now, managing rental properties can be a lot of work, and sometimes you need to hire help. Whether it's property manager, maintenance person, or even just a handyman, you can deduct the wages you pay them from your rental income. So essentially, this means you can lower your taxable income by the amount you pay your employees or your contractors on staff. Moving ahead, we have the home office deduction. Now, if you use a part of your home for rental business activities like making calls to tenants or organizing rental paperwork, you might be eligible for a home office deduction. This means you can deduct a portion of your home related expenses like utilities and insurance based on the size of your home office. It's a great way to save on taxes if you use your home for managing your rental properties. The next write-off we will talk about is your property taxes. Another significant tax advantage in real estate is the deductibility of property taxes. Whether you own a property for personal use or as a rental investment, you can deduct your property taxes from your taxable income. For example, if you pay $5,000 in property taxes annually, you can subtract this amount from your taxable income, potentially reducing your taxable liability. This deduction can result in substantial savings, especially if you own multiple properties or have high property tax bills. Now, knowing the current deduction limits for property taxes and how they impact your tax savings is essential. While there are caps on deductions for personal property taxes, investment properties typically allow for the full deduction of property taxes against your rental income. Next up, we have cash out refinance. Cash out refinancing allows homeowners to borrow against the equity in their home and receive a large lump sum of cash. This can be useful for real estate investors seeking funds for other investments or expenses. However, it's important to understand the tax implications of cash out refinancing. While the funds received are not considered taxable income, they do need to be paid back as a part of the refinance mortgage. Using cash out refinancing, real estate investors can't access the equity in their properties without triggering immediate tax consequences. They can then reinvest that cash into other properties, other investments to potentially generate higher returns. However, it is essential to carefully consider the risks and benefits of this strategy before proceeding, as increasing debt levels can also increase financial risks. For rental properties, the proceeds from cash out refinancing can be deducted as business expense against your rental income. This means that interest paid on the refinance mortgage may be tax deductible, potentially reducing the investor's overall tax liability. However, it is important consulting with a tax professional is advisable to ensure compliance with relevant tax laws and regulations. Up next, we have not taxed as self-employment income. Now, unlike income from self-employment, such as running a business or freelancing, rental income is not typically subject to self-employment tax. This can lead to significant tax savings for real estate investors, as they do not have to pay the additional Medicare and Social Security taxes that self-employed individuals are required to pay. Now, by earning rental income instead of self-employment income, real estate investors can save on taxes and retain more of their profits. This can be particularly advantageous for individuals who generate revenue from rental properties and self-employment activities, as they can allocate their resources to minimize their overall tax burden. Now, while rental income is generally not subject to self-employment tax, real estate investors must structure their investments tax efficiently. This may involve setting up the appropriate legal entities such as LLCs to minimize tax liabilities and maximize benefits. But besides, investors should consult with a tax professional to ensure compliance with relevant tax laws and regulations. Let's now move ahead and talk about the 1031 exchange. Now, a 1031 exchange is a powerful tax deferral strategy that allows real estate investors to defer taxes on capital gains from property sales. By exchanging one investment property for another of equal or greater value, you can postpone paying taxes on your gains, allowing you to reinvest them and potentially grow your wealth further. For example, if you sell a property and realize a significant portion, you would typically owe taxes on the capital gains, but however, with a 1031 exchange, you can defer these taxes by reinvesting the proceeds into another property. This strategy can be particularly advantageous for investors looking to upgrade or diversify their real estate portfolio without incurring immediate tax consequences. So essentially, to approach 1031 exchanges with caution and careful planning. While they offer significant tax benefits, failing to follow the IRS rules and guidelines can result in unintended tax consequences. Therefore, seeking guidance from a tax professional or a qualified intermediary is crucial when considering a 1031 exchange. Now, let's do a quick recap and most of all, give our important takeaway. So in this video, we covered several tax write-offs available to real estate investors, including mortgage interest, deduction, property taxes, depreciation, 1031 exchange, capital gains, exemption on primary residence, cash out refinancing, and tax treatment of rental income. It is important to remember that tax laws and regulations can be complex and vary depending on individual circumstances. Therefore, it's always advisable to seek guidance from a qualified tax professional before making any tax-related decision or taking advantage of a tax write-off. Are you ready to maximize your real estate investments and save big on taxes? Leave your comment below. If you found this video helpful, you'll definitely enjoy our other ones, so please consider subscribing to this channel. We value your feedback and suggestions for future videos on all things finance, so don't hesitate to let us know what you'd like to see in our upcoming videos. Till next time.